Hello, everybody. Welcome to the Palumbo Pulse, where we talk to some of the most sophisticated experts, portfolio managers, economists, market strategists, to get some insight to give us an edge when it comes to investing our hard-earned capital. Today, we have with us John McClure. John has 20 years experience as a portfolio manager. Had the great means of meeting him just about a couple months ago to learn about his strategy, his research. We're going to talk about today a lot. And it's our pleasure to have you on today, John. So thank you very much for your time. We appreciate it.
Thanks for having me.
All right, pleasure, man. So first, John, I want to start with you telling us about ProfitScore. Tell us about what you do, how you manage money, about your firm. Let's start there.
So we're at our heart of hearts, we're a data science organization. So we attempt to find predictive data elements using a hypothesis-driven process. So we have an idea that something might be causing something, and then we will source data, test out that hypothesis, attempt to model the data using the simplest possible expression possible. It would help us better trade financial assets. So in a nutshell, turn data into information and convert that information into dollars for our clients by trading financial assets.
Right. So when you say you look at data, right? So what is your typical time frame? How far back do you go to actually analyze data in the hypothesis to give you the confidence that, hey, this works great. We could actually trade this information. How far back do you have to go to make that actually be something that could be effective in managing money?
It's not a simple answer because, if the data that you model does not trade very much, it has very few trades, then you have to go way, 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 way back in the data to have comfort level in it. If it gives much more frequent input, then it's more statistically robust. But at the end of the day, we never take a piece of data, model it, and then put it to work in anything that we do. We have to, trade it in a real-time fashion, out of sample, because the only out of sample is real time, right? And so we like to have that data shot at a little bit, right? So if this is primarily a long biased, edge, and the market's going straight up for months and years, that's not really a very comfortable feeling, right? But if you go through a stretch where it's a real challenging market and that information performs really well, then you have a lot more confidence in it. So it's not just a one-to-one thing. You have to, it really depends on the situation. I wish I could give you a better answer, but.
Yeah, that's great. So in the Financial Times, there was an article today about quant firms, trend followers, how their strategies are finally starting to work, right? Because before it was more about the Fed intervention. Now that's kind of coming out of the system. So what is your view of that as the financial? I'm sure you didn't read the article, maybe you did. But the trend following quants, their strategies are finally starting to work. What are your thoughts behind that?
If you drill into the math, what makes a trend follower successful tends to be the length of time that the trend takes place. So if it chops around where it's going up and down and up and down, they tend to get chopped up, right? And they tend not to perform well in that environment. Where they really add the value is managing the tail risk, right? So if the markets really roll over and they get, destroyed, trend follower is going to add a lot of value because he's going to protect your assets from losing money. You understand the math. If you lose 50% on an investment, so $100 drops to 50, well, it's got to go up 100% to get back to break even. So the trick is not losing it, right? That's how you really win in this game, is protecting the downside as best as you can.
Right. So John, as many people are listening to this right now, with all the volatility that's going on, how are you doing and how are you managing through this?
Our equity portfolios are doing quite well. So, when I say equity portfolios, we're not a stock picker. We tend to, or we manage the beta risk in an index, the S&P 500. So when it's going up, obviously we would like to own it, and when it's going down, we don't want to own it. But our trading style changes dramatically based on whether the market's in a high vol state or in a low vol state. So when the market is in experiencing low volatility, it tends to grind higher day after day, week after week, month after month, year after year in some cases. And so in those environments, you want to position your assets to take advantage of that situation. So you'll put a trade on and you'll keep it on for days and sometimes a week. You might increase the exposure or lower the exposure so that you're taking advantage of a trending market. The equity market is mostly efficient. You always hear about efficiency in the market. It's mostly efficient. Where inefficiency comes to play is when volatility increases. So as volatility increases, market efficiency declines. And that inefficiency is a target-rich environment for someone that has information to let them trade on a short-term basis. So the market tends to overshoot, right? Hugely up and hugely down. I mean, you hear this common thing in the markets. What happens if you miss the 10 best days in the market? This is what your performance. Well, ironically, the 10 best days and the 10 worst days in the markets all happen when the price is below a 200-day moving average. So volatility begets more volatility. You know, there's some gentleman that won the Nobel Prize on the way that volatility clusters. So it tends to come in these volatility spurts. And when it does, people have to sell what they can versus what they have to. You have margin calls, and you have a whole bunch of reasons that the market expands in volatility as it attempts to try to find equilibrium. So when it's in a low vol state, you trade in one fashion. When it's in a high vol state, you tend to trade in another fashion.
So you would say that your strategy is definitely more trading oriented.
Yes, I mean, we're not going to put on a position and hold it for extended periods of time. We really focus on managing the risk. The challenge is you never know where that cliff's at, right? So when you're in a low volatility state, you have to manage it in a nervous way because you don't know. So, I mean, institutional clients, you know, the people that have a lot of money, they generally don't want home runs. They generally don't want triples. Some of them want doubles. Most of them want singles, right? They want consistency in their portfolio. And that's hard to do. It's not easy. It's quite difficult.
So John, so if I was Warren Buffett and I'm sitting in front of you, right? And you know his philosophy, we all know his philosophy, and I'm a big believer in his philosophy, right? Is kind of buy and hold good quality companies, large economic modes, good cash flow, and have that long-term time horizon because we don't know where the market's going. Like he says this tomorrow, next week, next month, next year, so forth. So because of that, you know, he just believes in good quality businesses for the long term. Obviously, you've been doing this for 20 years. Something made up your mind to say, okay, I know Warren Buffett's out there, Warren Buffett is out there and the like, but is it something that you say to yourself, you don't believe in what he's saying, or that's just internally not your makeup as an investor? Like what brought you to the point where you said, this is who I am, this is how I'm going to invest?
Psychologically, I mean, I've managed money directly for retail investors, right? And when the markets are down 50%, I mean, you know the number, half of them can't stand it, right? They're ready to jump off the roof. And so what do, right? They call you, they say, get me out, I don't care what. And as you and I know, that's the bottom, right? So they sell at the bottom and then it bounces up and goes huge. And so all we're trying to do is to smooth out that equity curve. Now, Warren Buffett, if you've got a very long-term horizon, then investing for the long term, buying great companies and doing all that kind of stuff, it works. I mean, the thing with Wall Street, there's a million different ways to make money and to do things. But our objective is like, over 10 years, if let's say the market averages 12% over a 10-year period. Well, the challenge is with the market is that that ride that gets you there is quite volatile, and it goes through these huge up and downs. And we're not saying we're going to make 30 or 40, some crazy number a year. What we say is that we're going to get you to the same place, right? We're going to get you to that 12% number, but our equity curve is going to have very small little wiggles in it, right? We're trying to compress the volatility out of the return stream and it's easier for clients to withstand that kind of volatility, right? And so that's our objective. We're a risk management firm through and through and through, and for institutional clients that already have, you take a large single family office that's got billions of dollars, their objective is don't lose my money, don't lose my money. You know what I mean? Their profile changes from the guy that's trying to go for home runs.
Yeah.
Does that make sense?
Yeah, absolutely. It makes sense. So before we get into your incredible research, which I'm really looking forward to talking about, the client that talks to you and says, John, I get what you just said, right? You'll get me to the same place as the market has done over the long term, but a much smoother ride. Great, got it. But how about taxes? The problem with the smoother ride is there's more turnover. More turnover means more taxes in non-retirement accounts. What do you say to combat that, or to give some comfort to that person that has an interest in investing with you?
It's not an easy answer, but I tell people, listen, I mean, how many people would have loved to pay taxes in 2008?
Yeah.
Right?
Yeah.
People would have paid you money to have the opportunity to pay taxes.
Well, even in this downturn now, with some
of people would love to pay taxes.
Yeah.
But there's an asset class that has some advantages for shorter term trading. It's financial futures, right? So S&P 500 futures will give you the same exposure as an S&P 500 index fund. And when you trade it, whether you hold it for 1 second or 10 years, 60% of all the gains are long-term capital gains and 40% are short-term capital gains. And there's no wash sales and all that. So if you are taking positions with a higher frequency, you're much better served to trade financial futures because of the tax advantages of them than you are, equity assets. Another thing that can be done is that you take Warren Buffett's methodology and you buy great companies, and you hire somebody like ProfitScore to come in and to hedge out that portfolio at certain times in the market.
I love that.
Yeah, so that you've got, the core holdings, and then you've got a hedge going on. So there's, financial futures are not for leverage sake. They're a financial tool that, if used correctly and appropriately, you don't add any more risk to the portfolio. You actually lower the risk to the portfolio.
So, John, with everything going on today, the volatility and the Fed, again, we're going to get into in a moment. Nobody has a crystal ball, but what is your view in terms of where we are going as an economy and capital markets as you see it, based on your experience, knowledge, et cetera?
Take what I say with a grain of salt, because risk management people like me, I mean, we predicted 10 out of the last 3 bear markets, right? I mean, we're always sitting with our back against the wall and nervous about what's going to happen. But there's some real math behind what's going on right now. I mean, there's some real solid math. I mean, let me just say this before I talk Fed talk, right? So we've worked with the Fed in the past, right? I mean, our challenge to find more unique sources of data. I've talked to their analysts. They're stand-up people. They're smart as heck. They're all the right things. And the Fed has an impossible job. The dual mandate, right? Full employment and managing inflation. I mean, we haven't had inflation in this country since the 70s. And so the dual mandate came out in 1977. But it wasn't very long after that Paul Volcker broke the back of inflation. And so we've been on this downward slide. And that's going to change, Phil. And I mean, it's just, you look back, I mean, what happened in the early 90s? Well, this country called China decided they're going to move all their people from the inland parts of China to the big cities, and they're going to put them to work. And this globalization, where we started exporting out all of our manufacturing, it greatly reduced cost, right? But that same labor in China is, 5x more expensive today than it was back then. And there's probably not another country that can kind of, I don't know if force is the right word, but they sure mandated their people to work a certain way in these factories to do it. It's pull all these people out of difficult situations and put money in their pocket. But that has had a tremendous downward effect on inflation. And that's going away for a lot of different reasons, right?
Right,
So
right.
I see inflation. I think the bottom's in on inflation. And I think this is going to be something that we're going to be dealing with for some time. And the Fed is got a very difficult job in front of them trying to fight inflation. And I mean, the full employment should be handled by the executive branch and the congressional branch. And they have an impossible job. And I'm an armchair quarterback looking back and say, the Fed should have done this or they should have done that. But I'm not a Fed basher. But they've got a difficult job. And what they're about to face and what we're experiencing is the result of that difficult job. And I can get into the details of it however you'd like. But
so if you had to predict, do you predict a recession coming?
I do. I predict a bear market. There's so much money sloshing around out there, as we'll get into the details of this in a minute. And the Fed's been such a manipulator of the market for the last 14 years. If they don't change their stance, right? I mean, if they continue balance sheet normalization, which starts in June and hasn't even started yet, and they have to lift interest rates where we think they're going to have to lift them, it's going to be very challenging for risk assets for some time.
So let's get into the Fed, and I agree with you. And this is where your research will come in play. But I just want to, for the audience that's listening that may not be following this stuff like we do on a daily basis. So the Fed really was doing three things, right? The Fed was decreasing rates or keeping rates low. Now they're doing the opposite, increasing rates. The second thing they were doing is buying bonds on a monthly basis. And the third thing they were doing, or they're going to do now, is actually start to let bonds roll off the balance sheet, right?
Yes.
So explain to the audience first, the Fed and what the Fed has been doing over the past 14 years, how that has helped the economy and essentially risk assets. And now what the Fed is embarking on and will embark on with quantitative tightening starting in June, like you said, and what your research has shown you as we talk about the Fed.
Okay, so I mean, everybody's heard of quantitative easing, right? The Fed's done 4 rounds of quantitative easing since 2008. And what is quantitative easing? Well, quantitative easing is when the Fed comes into the market and they buy financial assets. So anytime I refer to financial assets in this call, I'm referring to US Treasuries and mortgage-backed securities. And so we went back to January of 2008 and we read Fed statements, Fed minutes, Fed anything written down that we could, quote, relive history on. We walked it forward month by month and we downloaded the Fed's very transparent. You know how many assets are on their books every week. You can go download the data, drop it into Excel. So we pulled in all this information and painstakingly and slowly relived history moving back over time. Now, there's some big changes that have occurred. So in I think it was in October of 2008, the Fed came out and said, we're going to start buying assets, Treasury assets. Now, it took them months to put this facility in place because prior to this, they never did this trade. I mean, they had like $470 billion on their balance sheet prior to 2008 or in October, the fall of 2008. So they had to put the facilities in place to actually go in and start doing this. And I didn't remember all this at the time, but
Right.
They came in and bought a small amount of assets in February of 2009. And then they came in and really started buying some assets in March. And i.e. that was the bottom of the markets, right? Not only did they buy treasuries, they bought mortgage-backed securities. And they probably should buy mortgage-backed securities because there was no liquidity, there was no market. It was in complete disarray after the housing collapse. Because the Fed, they want to have price stability. So they don't want markets to go down because of illiquidity. When there's nobody to take the other side of the trade, that's when things get absolutely stark raving mad. And the Fed should make sure that markets function in a liquid manner. What they shouldn't do is manipulate the markets and cause them to go up. Right. So through this history lesson, Phil, because the Fed can't give you and me are the average citizen. They can't give us money. Okay. The Treasury can give us money. I think about these loans and all the things that came out of the Treasury during COVID, but the Fed can't directly give you and me money. But what they've learned is if they go into the mortgage-backed market and they buy mortgage-backed securities, if they're buying them in size, what do you think happens to the price of mortgage interest rates? They go down, right? And when mortgage interest rates go down, what generally happens to the price of real estate?
Goes up.
It goes up. And when real estate goes up, what do Americans like to do? Right? They like to put that ATM card in their house, get a second on it, pull cash out, and go spend money.
So it's,
right?
it's an indirect way of getting money to the country. But before we go there for one second, I just want to go back real quick. I'm sorry about this.
Yeah, if I skipped ahead, I'm sorry.
No, you're good. You're good. You're good. So I think people want to understand, right? So when we say the Fed is buying treasuries and mortgage-backed securities, okay? So the Fed is buying those treasury bonds and mortgage-backed securities with what money? Are they printing money to buy these bonds?
Yeah, the Fed tells the Treasury when and how much to print, right? And the Treasury prints the money. The Treasury doesn't say print. I mean, it's the Fed's an independent organization,
right?
I mean, so the chairman's appointed by the president, the Congress gives him the stamp of approval. But interestingly, the president can't fire the Fed chairman. It's only Congress that can fire the Fed chairman. Remember all the Trump hubbub? That was like, he can't fire him, right? So,
so they get the money from the Treasury, and then who do they buy these Treasury bonds through in these mortgage-backed securities?
That's a very important part of the question, right? So they go into the secondary market and buy these assets. They don't buy them directly from the Treasury, which when they did that, then you're going to want to like hide your wife and children, underneath the bed.
Right. So they buy these bonds in the secondary market from primarily probably banks and institutions who can sell them these bonds at size.
That's correct.
And now what happens with these banks? Now they become liquid because they're getting access to this capital, right? So that when we say liquid, because
they get cash.
They get cash, and they take this cash and they put it on their balance sheet and then utilize that capital to do whatever banks essentially do. I don't know if we know what the number is, but I'm wondering what percentages of the sellers came from banks and institutions. I mean, retail must be nothing, negligible, but I mean, primarily it must be big institutions
or governments.
Or governments, right?
Yeah.
And banks, right? So, okay. So now I think we pretty much get it, right? So they get the money from the Treasury, and then they take the money, go into secondary market, and they buy bonds from banks or institutions. Now those banks and institutions have that capital, and that's where the liquidity happens. Now, if the Fed is not buying these bonds, then there may not be enough money in the system to trade these bonds, and that's why credit markets may or can freeze up.
Yes, if there's not enough buyers and sellers creating a market, liquidity can become a problem. But that generally, I mean, they bought mortgage backs because it was a liquidity issue in 2009. But they didn't buy treasuries because of a liquidity issue. They bought treasuries to stimulate the economy because they wanted to put cash in the hands of banks with the hope that the banks would go in and lend money.
Correct.
That lend money stimulates the economy.
Right.
And so they're going after the banks to stimulate, and by buying mortgage backs, they're causing this effect in the real estate market, right? Which gives money directly to the consumers, right? So, and they didn't realize the mortgage back play when they started doing it in 2009. And in my humble opinion, right? I'm just estimating. They didn't realize this was going on. And then they saw the effect that it had into the economy, right? The wealth effect, right? It gives the wealth effect. When you feel like you got more money, you're more comfortable to go out and spend. And the reason I know that they know this now is that they came in and bought mortgage backs after COVID, right? They didn't need to buy mortgage backs in March and April of COVID. There was a market there for that.
Right.
but they bought $1.5 trillion worth of those puppies.
Yeah.
Starting in COVID, they got $3 trillion worth of mortgage backs on their books. So they know that trade quite well. I'm convinced, right?
So John,
Yes.
so now someone who's listening, now they sort of get it, right? So now we just went through kind of how it all works. And now what's going on today, which is part of your research, is the Fed now is increasing interest rates and they're not buying bonds. So that liquidity going to banks and institutions has stopped as of March. And now in everything they've done, built up this $9 trillion balance sheet. And now the Fed is going to let these bonds roll off their balance sheet or even sell bonds, right? And to reduce their balance sheet down over the next couple, 3 years to like, maybe reduce it by $2 or $3 trillion. So with all of this, so now go back to your research if you would. So your research was all done based on looking at when the Fed stopped buying bonds since 2008 and how risk assets performed during those periods, correct?
Yes. So this is actually tradable information, right? It's not forward looking. You can date it back, and the math is this: if the Fed is buying assets, or they haven't just told you they're going to quit buying assets, because buying assets is a knee-jerk reaction from the Federal Reserve. The markets are blowing up, right? For some reason, they come in, quantitative easing, they start buying assets to calm things down. But when they're going to stop buying assets, they don't want to freak the markets out. So they telegraph what they're going to do.
Right.
So on December the 28th of last year, they said, hey, we're going to stop buying assets in March of 2020. They actually, some of the Fed people were speaking before that, kind of leaking this thing out, how they do. But they gave you warning, we're going to stop in March. You don't need to wait until they officially stop. When they tell you they're going to stop, the market knows this trade, right? So, what's happened since January until now is case in point, right? This is what has happened historically. So what we did is we're like, okay, let's look at the performance of risk assets when the Fed has their foot on the gas, and their foot on the gas meaning buy assets. That's the only thing that matters when they buy. Now you get lost in the minutia. Well, they're selling assets, they're normalizing their balance sheet. We really couldn't find any tangible evidence where the Fed actually sold assets into the secondary market.
Right.
Now, they probably did some, but it would have been in very small numbers. What they do is they normalize their balance sheet. I don't call that tightening. Tightening is when they actually sell assets into the secondary market, in my humble opinion. But normalizing means they let the bonds that are on their balance sheet. Now, mind you, their balance sheet is $9 trillion, right? So there's a lot of bonds that mature every month, and they just don't buy them back, right? And so they've got a lot of short-term treasuries on their balance sheet that over the next couple of years, they're going to mature. And just if they don't buy anything back, their balance sheet's going to go down, trillions of dollars, right, in size. So selling into the secondary market, now that is a tough trade, because in the peak of the after COVID collapse, right, they became a third of the mortgage-backed marketplace. They were a liquidity provider extraordinaire, and to go from a huge liquidity provider to a net seller, well, mass pandemonium is going to break out if that occurs. But what happens is when the Fed has their foot on the gas pedal, right? They are buying assets, whether it's mortgage-backed or treasuries. Risk assets go up, and they do really, really well. So if all you did is said, hey, I'm only going to own the S&P 500 when the Fed has their foot on the gas, since 2008, you would have made on average 13.7%, which is a great trade. Your peak to valley drawdowns, 22%. Your standard deviations around 14%. All the risk statistics, everything lines up real nicely. Then if you said, well, hey, I'm only going to own the S&P when they don't have their foot on the gas, which means they could be selling, normalizing, whatever. They don't have their foot on the gas. Well,
like what's going on now.
right. You
So
lose.
raising of interest rates or decreasing rates had nothing to do with your research?
Correct. We didn't look at that. We did look at that. And what we determined was that 95% of the effect comes from the asset purchases versus not, right? And so when they are not purchasing assets since '08, your average annual return on the S&P has been a negative 2.59%. You experience your maximum peak to valley drawdown, your standard deviation goes to the moon. I mean, volatility spikes, you get all these clusters, you get, it's just ugly. It's just ugly. Now, people challenge me and they say, well, they didn't used to do this prior to '08. And
I was just going to say that, actually.
I violently agree with you. I mean, the market flowed in a much more natural process. It was driven much more by rates, but we're not in that environment right now. And what I really caution, if you've got money managers or people on your show, your opinion about what's going on and what's probably going to go happen in the next year is skewed. It's based on what's happened in the last 14 years. And what's happened in the last 14 years is not normal. I mean, the Fed has literally purchased $8.5 trillion worth of assets. They pumped all this liquidity into the marketplace. And it's given risk assets a artificial balance. I mean, the market should be based on earnings and all this kind of stuff naturally, right? I mean, unfortunately, we're capitalists in bull markets, and we quickly turn to socialists in bear markets, right? And it shouldn't function in that way, right? I mean, that's not how this play should work out. And like I said, the Fed's got an impossible job. Now, the insidious part of this is mortgage-backed securities really put cash in the hands of consumers. When I say it's insidious, it's because it's a levered trade, because the average person is levered on their house 10-1, 10-2, 10-3. And so when they went out and took that second money, it's levered money. And so you've given risk assets a kicker, but you've done it on the backs of levered money. So if real estate assets go down, things can really get nasty.
Oh, absolutely.
I live in Boise, Idaho, which is based on, if you take income, it's the most expensive real estate market in the country right now. It's overvalued 30%. So, and there's plenty of other markets out there across the United States are in the same scenario. So at the end of the day, everybody wants real functioning markets, right? We don't want manipulated markets.
We really do. And, the question is can we get there? For me, it's like there's just no playbook for everything that's going on right now. Everything from what happened with COVID to this recovery with the economy, the excess inventory that's been built up, where it's going to go. We're going to go into recession, not going to go into recession. You listen to bulls, you listen to the bears. I don't know what bulls are thinking, in my opinion. But so when you think about what fascinated me about what you put together in your research, John, was that, when you have the Fed that takes his foot off the gas, like you talked about before, like we're in the environment today, when we plugged in every asset class, ETFs, right, into your research, we found that you made no money. You made no money. There was no money to be made anywhere.
Yeah, there was no place to hide.
There was no place to hide except cash, right?
So it was tough.
That was it, right? So that was basically it. So someone who's listening, as our audience is listening right now, and they hear us say this, your research, when the Fed has his foot on the gas since 2008, risk assets do great, and now we understand why. Money in the system, banks get the money, they lend out, right? When the Fed's in the system, rates go lower. That means that props up risk assets, and oftentimes, unfortunately, consumers go tap into their home. That's their way of getting capital, and they go out there and spend. 70% of the economy is the consumer. So that makes sense. Now, when the Fed takes his foot off the gas, which he's doing now, and you've learned, and I learned because of you, that when the Fed does this, no investments perform well except for cash on a relative basis. So what does one investor do? And as I think about this, John, the way it's probably going to play out, it's kind of what I've been saying, and I want to know what you think about this, is I feel like, and I don't know if the Fed deliberately did this, but I think the Fed said, you guys, listen, let's get on TV, let's get in, when we get interviewed, let's be overly hawkish now because we kind of, in a way, screwed up, right? But now let's get ahead of this. Let's be overly hawkish in every aspect, because once we get there, we'll see how markets are doing. We could always then cool things down. So my point is that yes, when we plug in those different asset classes into your research, performance looks dismal, but there's probably going to be a time, maybe it's this year, maybe next year, where the Fed's going to just cool things down, become a little bit less hawkish to less hawkish to then dovish, and then maybe saying, right, maybe I'll stop buying bonds again. So, and that's the only way that you can get risk assets to perform well again when you really think about it, John, right? I mean, when you really think about it, that's the only way I can see things. And now it goes back to what you just said before. Are we ever going to be functioning as a normalized market ever again? Unless as he's taking his foot off the gas, everything can function normally, which I don't believe to be true. Again, we could be wrong. It's just our view. So just a lot at you just now. Your thoughts?
We're addicted to this.
We really are. We totally are.
We all got a needle in our arm. I mean, it's addiction full on, and breaking that addiction is going to be tough. I mean, I just don't see any way around it, and it needs to be. We need to break this addiction.
Totally.
I mean, the United States is blessed on so many fronts, right? I mean, we don't have enough time for me to tell you all the great things that we have in this country, and we will bounce back. And but you've got a lot of craziness going on. Globalization is diminishing. There's no doubt about it, right? So the tailwind of cheap labor is going away, and it's going to be more of a headwind. And so inflation is going to be a problem that literally very few people that actively work in the markets can remember, right? So that's going to be a challenge. I mean, you talk about the war in Ukraine and the supply chain, and I mean, we could go through and list all these things.
That is so small comparable to the issues and challenges that the Fed has in front of them. It's not just navigating through this environment we're in, John. It's more like, it's almost like you got to think longer term. Like you plant the seed today to get a tree 20 years ago.
Yeah.
This is what it's got to be. We got to go through structural changes, and we got to feel some pain to get to normalization as a market and as an economy. And I don't know if the Fed has the courage to get there. And obviously, depending on who's president and who's in Congress and Senate, who's in Congress and between Senate and the House, right? They don't want the economy to collapse underneath them, because then what happens politically? So I personally believe that this is just going to be a vicious cycle that is going to continue until it can't. That's number one. Number two, John, I would say we're probably the best house on the worst block, because Europe is functioning the same way, Asia is functioning the same way. So it's not like we're the only country from a debt to GDP standpoint. We're pretty much hanging with everybody else. We're not even as bad as many of the other countries that are out there, right? So yes. It's just, and it brings me to what I'm going to close on in a moment. But that's want to hear your views on what I just said.
I mean, we kick the can down the road, and we don't plan ahead, and we keep pushing it, until we can't, right? And so, until we hit a wall. Unfortunately, that seems to be the case. When we hit that wall, we tend to respond well to it, and we fight our way out because we're blessed with all the resources that we have in the country. But man, it's going to be one thing. People say, well, is the market going up or down? I'm like, well, one thing I can tell you for certain is volatility is going to be nuts, right? I mean, we're going to experience bouts of volatility it's going to be crazy time. So people just need to put their seatbelt on and hang on. And thank the good Lord, we have two big oceans between us and pretty much everybody else. You know what I mean?
Thank God for that. I agree.
To be in the quagmire over there, mixing with all those countries in Europe, I just, what's going to happen? Yeah. I just hope we don't. I just hope we don't, implode from the inside out. My biggest complaint with the Fed is that there's no practitioners in there, right? I mean, if you look at the Fed chair, not the Fed chairman, but the Fed governors, they're lifetime Fed people.
Yeah.
Right. They're economists, but they're not practitioners, right? I mean, who would do a better job being the Fed chairman, Ray Dalio or Jerome Powell, right? The difference is Ray Dalio is a practitioner, right? If he makes bad decisions, he loses money and he gets fired, right? So if there somehow could bring more practitioners into the Fed to help navigate what's coming at us, Phil,
I agree with 100%. It's just like politicians, right? If you're a lifetime politician versus an actual business person that had success growing a business and understood employees and managing balance sheets and cash flows and growing a business, and then when they get into politics, right? They're not there for the money. They're there because they want to be there. They have enough money. They built up their wealth already, right? So it's the same, right? You're 100% right, and that's that is a problem within itself. And this is where I really genuinely believe. I was interviewed a couple of years ago by maybe in Forbes, I forget who it was, and they asked my opinion about alternative investments. And John, clients who listen to this, I have very little exposure to alternative investments the past 15 years, right? Really since 2008. And really my feeling always was that, with the Fed, interjecting into the economy as they have over the past 10, 13 years, you really don't need to be invested in hedge funds and all the alternatives and paying all those fees and expenses, because kind of a rising tide lifts all boats. But now that tide is going to be going out, like everything that we're talking about, I think alternative investments are more important today than ever. And I've never said that ever, because they are costly, they are expensive and all that jazz. And it's something I, obviously am very transparent with clients. But I do see the value of alternative investments, because not only are you investing long, but you're investing short and you're hedging, utilizing options, et cetera. And I think that's going to add value going forward because of the volatility that we're going to be experiencing. Like I started off the podcast talking about is the Financial Times, how trend following strategies are following to work. Managed futures funds are starting to work. And I think with the Fed now taking its foot off the gas, vol picking up, this is where you're going to see AI being a helpful asset within clients' portfolios as you think about things going forward.
Yeah, I mean, volatility is what feeds that machine, right? I mean,
absolutely.
So whether it's exploding high or lower or quicker turns, alternative investments tend to do really well as volatility increases. So I violently agree with you.
I mean, it helps you in what I'm saying, but I'm not even saying that because you're on. I'm saying,
yeah, I mean, it's the facts. If I did the same analysis on alternative assets and said, hey, when volatility is high, how do they perform? When volatility is low, it would have been the inverse of what, So you're exactly right.
Yeah, totally agree. Totally agree. I think we pretty much covered it all. Anything else you want to add that you think would be helpful? I don't know if this was a doom and gloom type call, Zoom call we just had just now. And that's okay if it is, but I think it's more just like, we want to provide and educate people. I think you just need to be on your toes more than ever today. You need to be more diversified and balanced more than ever. I think alternative investments is really going to be helpful within clients' portfolios. I think structured notes, not through the banks, but structured notes where they're getting a commission, not that, but structured notes that provide some downside protection. I just think that that's the world we're heading into, and you have to be a more cautious investor, and you also have to plan for a lower rate environment going forward. So from a planning perspective, if you're saying I want to stop working 5 years from now, you need this amount of assets and you're forecasting a certain rate of return, that rate of return, you have to go with a lower rate of return because we're going to be faced with going forward. So, that's kind of how I would say and summarize what we're trying to accomplish today. Any closing thoughts that you have that you'd like to add to this call?
Yeah, I hate when I hate to come across as a doom and gloom guy.
I know.
We're a risk management firm, right? We're American. We want America to succeed and prosper. And we just manage risk. We're a risk manager, right? So, but I mean, if you boil down the United States to its simplest parts, I mean, if you just looked at the United States as a piece of real estate, how many deep water ports we have, how much arable land we have, how much, river navigation we have. I mean, all these things that we have. I mean, there's no other country that even remotely compares. I mean, it's just we have this incredible. The United States is this incredible country, and it's got these incredible resources, and we have great, hardworking people, and we're going to persevere and get through it. There's no doubt about it. I just, hope and pray we just, we get wise heads in there that can help us make wise decisions. And we've got to quit spending our grandkids' money and I don't know what it is, our great grandkids' money. I mean, it's, but we'll figure it out. I'm convinced we're going to turn the corner and figure this thing out. But in the meantime, protect yourself, because everything I know of, everything I can see, volatility is going to be high. So.
Yeah, I really appreciate you ending with that note, because I really do believe in America. And I think so many people want to bet against us. They've tried to bet against us. And in the end, we have, incredible innovativeness, with great inventors. We have the best companies in the world. Think about Apple and Google and Facebook and companies like that. So, you have to believe that you're investing in the American economy. I think we're going to go through some rough patches, but ultimately we persevere. I totally agree with that. So John, listen, well, first, I just want to end with one quick thing. So we spoke just 2 days ago. Your equity portfolio you run, the S&P is down 17%, 16% as we're talking. Your equity fund is up what?
It's up north of 15% for the year.
Yeah, which is incredible. And it goes back to long, short, and your short-term trading tactics. So you've done a great job at ProfitScore. We look forward to doing business together. It's been a pleasure talking to you, John. I think your research is fantastic. You're a great guy, very knowledgeable. So we look forward to partnering together. Thank you so much for your time today. I appreciate that. Enjoy the rest of your day.
Hey, let me just say this, or my compliance guy might fire me. Past performance is not predictive.
Make sure you throw that in there.
See you guys.
All right. Thanks so much. Okay. Enjoy.
Thanks for your opportunity, Phil.
My pleasure.